Okay, good morning, everyone, and you're very welcome to this morning's Coffee Microcaps Morning Meeting. My name is Mark Tobin. For anybody who's joining us for the first time, and for all our regular attendees, you're very welcome back. I'm just going to quickly run through these intro slides, and then we're going to get straight into it with our presenter this morning. A quick mention to our sponsor, RAS Research Service, who are our virtual event sponsor here, Coffee Microcaps. And if you are looking for some institutional grade research on some smaller microcap names not really covered by the sell side brokers, please do check out their website for some of their coverage there. As always, a warm welcome to ASIC as well if you're joining us this morning. For anybody who is joining us for the first time, the companies we tend to have on here, capped under 300 million, our definition of a microcap, are generally in revenue, approaching cash flow break even, or in the case of our presenter this morning, already profitable and dividend paying, I'll mention as well. We tend not to have companies from the resources and biotech sector. We tend to focus on what I call industrial microcaps, which kind of covers everything else from financial services, professional services, industrial businesses, tech businesses, healthcare, kind of everything outside of resources and biotech. Structure this morning's webinar, we've got one company with us this morning. We'll be here for about 30 minutes, a 20-minute press off, and then 10 minutes of Q&A. If you do have any questions, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions. Please know the webinar is being recorded and it'll be on the Coffee Microcaps YouTube channel tomorrow morning. Follow us. You can pretty much get us on most of the socials. Twitter's our main one. YouTube for all our recordings of the webinars. I'll just mention we had 15 companies present over reporting season. All of those are still pretty fresh and up on the YouTube channel, LinkedIn, and I have a free monthly newsletter that you can get on the Substack platform. So without further ado, I'd like to introduce Sam Budiselik, Managing Director and CEO of Cash Converters, coming back to us and joining us live from Perth. Sam, good morning.
Good morning, Mark.
I'm just going to take down my slides there. If you want to put up your preso, I'll let you know once I can see it coming through.
Yep. Hopefully that's
yeah,
coming through.
yeah, it's
Full
there
screen.
now. Full screen. Yep, there you go. It looks perfect,
Great.
Sam. You can take it away.
Great. Thank you, Mark. Yeah, and thank you to those who have dialed in. I'm recently back from a trip to the UK. I can talk a little bit more about that in a minute as to how much potential we've got over there. But thankfully, off the back of Liberation Day, we're a company that isn't impacted by tariffs and other international external events. So we'll take that as a win. Just briefly looking at the half that we had, we've spent a lot of time. I've been in the business for nearly 10 years now. We've spent a majority of that time really rebuilding our platform, our tech stack, and more recently, really trying to start to simplify our business. And I think we're fortunate just to have good growing demand in our customer segment. And having navigated many sort of recent regulatory challenges as to how we meet that demand, we're in a really strong position now. We are a big business. I think for those following us, it doesn't come as a surprise. But when you talk to new interest, it's quite great watching people's face. The look of surprise when on a half-year basis we're pushing near 200 mil of revenue. And on a full year basis, sort of 65 million EBITDA and a net profit of 22, something like that. So the business, whilst we've really changed the shape and the positioning of the business, we've maintained profitability, as you touched on, Mark. We've been paying a 2-cent dividend per annum, fully franked, for the last 4 years or so. We're generating good free cash, and we're deploying that into some store acquisitions I'll talk about in a minute. But at the half, we closed with a strong cash position, good strong gross loan book, which we're repositioning, and lower than what I would say were normal net loss rates for a business like ours. I kind of think of us in a band of 10 to 12% on a net loss basis, and I think it's a credit to our credit model and also just the performance of the underlying consumer remaining strong as people remain employed, and our loan books are performing exceptionally well. And some of the financials on the right, I think, hopefully just underline that we've got some good upside and a bright future in front of us when you look at the strength of the business. One of the key call outs before we sort of start to get into the next layer down in terms of the detail, the chart on the left with that blue box showing the offshore revenue that we've introduced into the business through recent acquisitions of two fairly significant networks, New Zealand and the UK. Just touching on New Zealand briefly, we acquired our license back in New Zealand, and there's 20 odd stores, 10 corporate, 10 franchise in New Zealand, and a network that could possibly grow. But at the point of acquiring that New Zealand business, we were facing some headwinds that then sort of played through retail markets in particular in New Zealand over the last sort of 2 years. But having repositioned our business, we tripled our provision on the loan book in New Zealand. It was pretty significant as we faced into some changing economic and I guess demographic challenges in New Zealand. We've really seen that business turn and become profitable again in this half. And I kind of feel like we're back onto that original forecast we thought for New Zealand. We have a pretty positive outlook on that market. Probably not material, but it'll certainly be profitable and it'll be contributing over the next few years, which is great. But really key is the UK. We made an acquisition in the UK probably about 18 months ago from memory of a 42 store network that gave us a strong foothold in the UK to operate a corporate model, and a management team that came with that business that still remain in place and have continued acquiring stores. We've gone from 42 to I think 47 now in the UK. So that business is growing strongly. From an EBITDA perspective, the UK traditionally we operated a master franchise model that contributed maybe about £1 million of EBITDA. That's up to £6.5 million now, and we see that growing as we continue acquiring stores, and we continue providing capital to that corporate business now to keep growing that business. We can talk about that in a minute. But through this cycle, we've seen operating net profit still maintained, EBITDA still maintained, and our gross loan book sort of starting to trend down a bit by design, and we'll talk about that in a minute. Just back to our business again, just as a brief reintroduction if you haven't followed the story for a while. I kind of think of Cashies really now as a non-bank lender to subprime or non-conforming customers looking for personal loans or credit. We've really invested in that part of our business over recent years to really a massive uplift in terms of compliance, and the regulatory oversight in this non-bank part of the market, and bank and superannuation's really lifted, which is a good thing. But in our part of the market, we have high hurdles and high onerous obligations in terms of our origination and responsible lending. And really the only way that you can operate in this part of the market is to have large scale and leading technology. Large scale, lots of bank statements to feed your credit models, and then the technology to enable your machine learning driven credit modeling of the risk profile of customers in our segment. And the key part of the lending change that we've really started initiating now, having rebuilt the platform, we're now shifting away from what is really referred to as payday lending. We've really got 3 loan products, up to $2,000 loans, $2,000 to $5,000 loans, and then a line of credit. And I think the risk profile of the customer or the loss rates are highest in the small loans, and they tail down as you get to a larger loan amount or a better quality customer. And we've made the decision, whilst the small loan product is well structured and regulated in Australia, we've just made the decision to move away from that product. Having now got the technology in place to give us confidence we can transition customers in the right way, we can offer lower headline rates to customers and lower costs to the customer in terms of loan options. But significantly, moving away from the payday loan space really opens up a number of other opportunities for our business, including primarily lower cost funding options. But it also very much changes the conversation in a regulatory environment, as you can imagine. It doesn't mean that we're not still probably the industry leader, or definitely the industry leader in terms of defining vulnerable customers and caring for vulnerable customers, which ASIC has stated as a mission in terms of financial inclusion. We still will do that, but we're just changing the look, the feel, and the offer to the customer through the business as we move forward. Retail, the traditional retail business that we're probably best known for, secondhand, repurposed goods and pawnbroking through our store network. Really, that store segment's had a record half as we've, number one, come in and looked at the cost base of the stores and really overhauled the store model to a smaller, tighter footprint with higher end inventory across our network. We're seeing better gross margins and better turnover, and the quality of the inventory in the stores now is starting to shift that customer mix in that part of the business as well, which is really interesting. We're certainly moving into a more middle class, higher average transaction sort of space for our retail business. At the extreme, we have just opened a luxury only store in Bondi Junction, and I'll show a few photos on that in a bit. But we think we can take this concept as far as a luxury only store where you've only got high-end handbags, jewelry, watches, and consumer electronics. None of the other traditional inventory mix that we've carried. Through our network, we'll still offer that. Through these inventory stores, we'll still buy everything, and then we'll place them out through the other stores as they come through. And we do, a lot of businesses are talking about leveraging AI. I kind of think of the main benefit of AI in our business being the machine learning powered credit models in the lending business. But through our store network, we do leverage AI to authenticate handbags and some items of clothing. We're pretty good at authenticating jewelry and watches, having a long history and that IP in the network, but we will take them down to a jeweler if they're high value and we want to confirm authenticity. But in general, that AI has allowed us to really purchase more handbags and high-end clothing and shoes, which, it's a high-definition photo taken, read back to a database. It will come back and the product will be authenticated genuine. It will actually be underwritten by the technology provider. They're that confident in that authentication, which is terrific. And I think we'll continue to see that operating leverage through our stores. We can really sell everything that we buy. So the more inventory we can attract to our retail business, the more we sell. Holding our cost base flat obviously gives us some pretty good operating scale, which is exciting. And putting those two pillars of our business together, really what we're looking to do is to do more of that through our corporate-owned network. So we're very much committed to buying back the franchise store network in Australia and the UK, and you'll see we've seeded those acquisitions. I think the main point there is that we've really built a very detailed and well-proven investment acquisition model where we will run off the top level revenue that we're seeing in these stores, which we have visibility of with these stores on our platform. We'll run a corporate cost overlay on that and then make an offer, 3.5 to 4.5 times our version of that store's EBITDA, generally is how we operate. And when we've been buying those stores in, we do see upside because we can provide capital into those businesses to really get their loan books growing, to facilitate bigger pawn books and to facilitate inventory turnover. And the UK acquisition that we publicly stated a 4.8 multiple on because it was a big strategic network that seeded that beachhead in the UK. 12 months later, that was trading at about 3.8 times in terms of the multiple as we got that business growing. And on a like-for-like basis, we saw that multiple decrease as a result. So we've got great confidence in our approach to acquiring the stores, and we've got a strong pipeline of those stores lined up. I'll show a slide in a minute talking about the numbers and go into a bit more detail. So in summary, the journey of the last few years really now sees us exiting the small loan book and I recall that loan book north of $100 million not long ago, and we're under $50 million now, and it's less than 20% of the consolidated gross loan book. We've been saying transitioning out of that business because we've had to take our network on a journey. If we exit that space, we needed new product coming through, and we needed to think about the customer journey. How do we help these customers that are really going to be impacted from this transition or even a possible future exit? So it's been a big internal project, but it's really progressing well. Super happy with how things are playing out. For those interested, ASIC did just release a report on the sector, 805. It's a SAC review. And I think everything they called out as a concern, I'm very comfortable that we're not doing or we've already addressed. So we're very well positioned to continue growing our medium loan book and our new line of credit product. We did take the decision to cease vehicle lending in 24. Again, ASIC have just published a report, a notification that market is going to be reviewed as a priority. We felt more so that the capital tied up in that loan book, it's still about $20 million of our cash would be better deployed to the franchise store acquisitions. We get a better return on that than we did from that vehicle lending. And subscale that book at 74 mil, sort of where we topped out. We were just too small to make a meaningful return in that market. So that exit continues to plan, and that book's at 60 mil at the half. Launched a new loan product, as I said, and that's growing strongly. And our retail stores, there's still some upside there as we continue to roll the model through, which I'll show in a minute. I will skip through the P&L. I think the P&L's there if people have any questions, or I'm happy to answer anything in particular. Just the point being, strong top line revenue. I think our interest costs are high. We've really floated with the floating rate as the 13 odd rate rises have run through. Our interest costs have increased as we run a swap plus margin pricing model on our securitization facility, and have obviously not passed that through to the customer. So, in summary, as the rates come down, we should see some interest cost out, which is great, but have still managed to grow profitability irrespective of those challenges. Balance sheet, like I said, we've got cash on the balance sheet, which is great. It allows us to continue acquiring the stores at a steady pace as we continue generating free cash, building that war chest up, and then deploying that war chest on acquisitions. And that's really, I think, the main message out of those slides. So just sort of circling back a little, the loan business has been through a lot. It's a really key point, I think, to say that, as we exit those small loans, looking forward, we'll have a future state of only medium loans and what we're calling a line of credit. The line of credit is just a loan product that awards a customer a line. It might be a $2,500 line. Day one, it amortizes over 18 months. So if that customer makes the payments, that loan would fully term out. But if the customer on the way through the journey pays back 25% of that loan amount and wishes to redraw that loan back to the full credit amount of $2,500, they can do so, provided when we take bank statements and run a check, nothing's deteriorated or there's no major changes. That customer has access to that headroom in that loan product. And with no establishment fees on that loan product, I think it's the future for this business. Obviously, as the margin's a lot lower than the small amount loan product margin, we have to have a higher quality customer offered that loan product to make that viable. But the customers in our business that we've got a good risk view on, we'll hopefully be able to help with that product. And then winning new customers is what we're really turning our minds to. The retail side, I've just put a few photos into Bondi. This is a Bondi Junction, the store we opened in August. It doesn't really do the store justice. I've been a big fan of this concept for many years, and when I walked in, I was just thrilled to see the store. It's amazing. Taking investors in, I think people are really surprised with the quality of the inventory. As you walk in, there's a whole Louis Vuitton cabinet, a whole Burberry cabinet, a whole Coach cabinet of just handbags, glasses, and high-end items. And like I say, the velocity of the inventory being sold into this store is really interesting. It's really bringing a lot of stock to our network more stock than we can possibly sell through this one store, which is great for our other stores in New South Wales that benefit from that stock being transferred. And it is branded Cashies. It looks and feels like a higher end version of one of our smaller stores, but we've remained committed to the brand, and we'll continue to invest in our core brand and see how far that can kind of stretch into that middle market. And so far, it's working really well. I think the other benefit is that the pawn book in that store has grown substantially because of the higher value inventory on display. It tends to lead to higher value inventory being pledged for loans. And small business owners that have got a cash flow crunch, whether it's a mid-month salary run or something they need some money for, pledging a higher end item is working well for them in terms of meeting that cash need. So really positive start. We could probably have 3 or 4 of these in New South Wales, a couple in Victoria and Melbourne, and a couple in Brisbane, and we might build out along that eastern seaboard and just see whether we can continue this momentum. And the feedback from customers is quite amazing. I think as we're shifting the brand and what it's known for on the lending side, it's also the retail side evolving, and it's great to see this sort of feedback online as a result. So just swinging back to the franchise opportunities, if we focus in on Australia and the UK, there's still, about half of the Aussie network is still franchise owned, and about 3/4 of the UK. And the majority of our franchise partners were really part of seeding our store network in both of these regions over time. Having operated in Australia for 40 years and the UK for 30 years, there's a lot of long-time owners that are looking for a natural exit from the business. And we've really started focusing on the bigger network operators as we feed the pipeline and review these opportunities. And, I think as a corporate strategy to corporatize the network is really our intent. And that's how we're talking to our franchise network when we catch up. There's a number of opportunities for us to fold these stores in. And like I said, we've just tried to give a high level feel for how we value the stores. But our IRRs on these acquisitions are often north of 20%. And like I say, there is some upside factored in from a corporate funding perspective of growing the loan book. So, really working well. And I think the more of these we can do, the better. In the UK, it's interesting too, because when the network was established, the franchise licenses were sold as territory licenses. So there's large parts of the UK that have kind of been locked up with a couple of stores when they should arguably have many more. And as we buy the licenses back, we're opening these territories too. And in both regions, we favour our bigger franchise partners that want to continue growing. We might buy some stores off them, provide some capital they can recycle into growth. But that will allow us to continue growing the store network, particularly in the UK, like I say. There's a couple of greenfield sites opened a year in the corporate network too. So, Australia's sitting at about 150. I can see it naturally growing to 200 stores. The UK at 190 odd, that could probably grow to 300 considering this territory opportunities. So, it's just such a great time for our business to keep expanding our network with a really close and productive relationship with the regulators in each of these markets. I think, hopefully we're seen as a big trusted operator, and we'll continue growing our networks just to reach more customers. And deliberately, the net profit contribution, as we change the loan book and wind the small loan product down, the yield mix changing on that loan book comes down. I think it's a good thing over time. It becomes more sustainable. We can take some cost out of our business. It's very costly to originate a small loan. You can imagine trying to meet the obligations we have to originate a $500 personal loan. As we exit that part of the market, we can release some cost. But we do need to think about continuing to grow our earnings. And a part of our strategy is to have the store acquisitions coming in and earnings growing. And the beauty of the store network is that because they already sit on our IT platform for point of sale and for lending, there's no change following the acquisition of one of these store networks. We really just transfer the staff contracts across to corporate employment and carry on trading. It's really that simple. So just to finish up, Mark, I think I just would summarise our strategy as simplifying our business, reallocating some of our capital to our growth areas that we want to focus on, which is acquiring our franchise stores and funding the new loan book growth that we've got into our securitisation facility, which we've recently renewed. So we have good headroom in that to continue growing our loan books. And, overall continuing that cost focus and that discipline around the business cost base should over time, continue growing our EBITDA, growing our free cash. And, over time, I'd like to think that we could consider growing our dividend. And on that note, Mark, I'll finish there and hand back to yourself.
Yeah, perfect. Thanks, Sam. I think that's a good word to finish, because our first question was also kind of a question I was going to ask on the dividend. You mentioned, you've been steady at 2 cents for the last couple of years. And the first question up here is, can you maybe break down what your and the board's kind of thinking is on capital management, profits generated every year, but how that gets allocated to capital needed to grow the loan book, capital for acquisitions versus, trying to reward shareholders with, a dividend payout thing that you've been very consistent about paying that 1 cent every half for I think it's four years now. So maybe just give us a little thought on, where that kind of mix levels out in the let's say in the medium term, if we look forward over the next 3 years, maybe.
Yeah, good question. I get asked this a bit, obviously, because I think there's interest in the prospect for maybe an increase in the dividend. Look, I think we've shown we've been pretty prudent with the way we've managed our capital, and with a lot of change in this business. As recently as the end of December 23, there were more changes around that small loan product, and that's had a big impact on the margin of the loan book and the mix of the loan book. And as we look forward, we're prioritising, managing the earnings mix of the business to continue earnings growing, but a big shift in that contribution from segments. So there's a fair bit going on under the hood. It looks like a bit of a washing machine, which is now settling, which is good. So we're getting some more certainty around that outlook. With 60 mil of cash on the balance sheet, roughly, I kind of think of it like about 20 mil of that cash being tied up in our loan facility, washing in and out and allowing us to pay out and to settle loans. So about 25 cents on the dollar of a loan we cash fund. So as the books grow, we need some cash to fund the books. There's about 20 mil of working capital in there just through stores and being able to put cash in tills and run the business. And it leaves about 20 mil, say, of that cash to deploy on acquisitions or something else. What we've favoured is, like I say, buying the stores, bringing them in. On a return basis, that's a superior use of the capital, we think, and we feel we've proven that. And so whilst we've got those opportunities, we want to continue folding stores in and building a bigger network and growing our EBITDA, our earnings, our net profit earnings as well. I think what we've sort of done in the past is steady as she goes. If we've deployed about 20 mil of that cash amount each year to acquisitions, we've then replaced that cash through free cash, and then we're ready to go again. And as we've said through our strategy, we'd hope to be announcing some more store acquisitions in, each of the halves as we roll forward, as we continue that. So, as we continue to grow the business, I think in a sensible way, as we're investing in those acquisitions and that loan book growth, naturally we'll get to a point where, the free cash flowing off the business is going to be way beyond our need to acquire any more stores when that strategy finishes. We're not thinking of anything wider or anything crazy, no adjacent, like unrelated business acquisitions or anything like that. It's get these stores in, grow the retail network, grow the loan books in the UK and Oz, and then generate great earnings and great free cash. At that point, we'd be in a position, I think, hopefully, where we can say as a board, look, what, I'd love to focus on shareholder returns, being a major shareholder, but we'll consider all the opportunities for that capital as you would, and hopefully that's a part of it. I'd say that would be, in my mind, that's an 18-month sort of window though, because we've still got a big pipeline of store lined up. You can see those numbers that are still owned by the franchise network. I kind of want to go after all of them. Naturally we won't get all, but if we could get a majority, I'd rather focus on that in the short term to then ensure that we had that growth optionality built into the business going forward.
Maybe just a quick one, Sam. I see here it's not the next one up, but um, the split between on a revenue basis, and maybe you can just touch on it from a profit basis as well. On the retail side versus the finance side. I don't know if that was in one of those bar charts that you had there. And there's just a question, yeah, what is the split between the retailing revenue and the finance revenue? And maybe if we take that one down lower, like what that means for profitability as well.
Yeah, I start at if I start at EBITDA and net profit mark. If I start at EBITDA, which it's a bit removed because we are predominantly a finance business, but about two-thirds of our EBITDA is coming through that lending business, and about one-third through the rest. It's really about 25% stores, and the rest is just the franchise fees. So the franchise fees we receive as a business are very low. They're immaterial, and I don't even really think of us as a franchise business in terms of the contribution of that network from a fee perspective. Franchisees obviously refer loan flow, which is good for us, and we pay a commission for that. But predominantly, it's finance. Retail, the revenue's like 150 mil a year of that, say 400 total. So it's a substantial amount, but if you said a gross margin was around about 50%, it's a bit less. But there's a lot of cost comes out of the retail revenue, obviously. The finance revenue is sort of about 220 of that, I think. But the finance revenue, if we can keep lowering the loss rates and optimizing our credit models, that then obviously has a bigger kicker in terms of the earnings contribution.
Yeah. Maybe we
I
just
hope that
say
helps.
yeah.
In our segment disclosure in our accounts, we've got the numbers obviously with the head office overhead. So it's probably best to look down that segment breakdown and get that view.
Yeah.
Yeah,
Uh, and then I know we're going slightly over time. Sam, have you got 5 minutes maybe to tackle a few more of these?
sure.
Okay,
Yeah, I'd love
perfect.
to.
Another one then, I think it's literally the washing machine analogy you were talking about there. There's a question on, as you exit small loans, grow the line of credit and medium-term business, is there a timing difference on profitability and NIMs? The NIMs are tighter on the new products, as you mentioned, and having to recognize the expected credit loss up front. Is
Mm.
is that the washing machine process that has kind of been ongoing but is now kind of trailing off and the impact is becoming less? Is that fair to say?
Yeah, it's spot on. And I think simply if you look at the loss rates in that small loan product running at about 20 to 25%, something like that, and you look at the loss rates in that new product at sort of 10 to 12%, it's a very different um, loss profile. So you're really taking a lot of steam out of the engine. As a part of that wind down of that book, there is an ECL release going on where we start releasing that provision on that small loan book that's a lot higher than it will be going forward. By design, that helps us smooth earnings a bit, as does the new store income or earnings. And what we're trying to do is continue that momentum of earnings by having all of these contributors sort of feed in. Um, but it's really quite complex when you start trying to isolate each of those movements of ECL out, ECL up for the new loan products, and loss rates down, and it's a huge
Yeah.
transition going on. But I think I'm super pleased with the half that I feel like, it's not the two levers, it's probably five we're trying to keep a handle on, and it's working really nicely at the moment. It's also part of the reason why we didn't sell the GLA book, because the GLA book is also helping us transition that loan book too. There's earnings coming off that GLA loan book now because we really just removed all cost and we just collect those loans out. So there was another part of the strategy was just to have the GLA book contribute to smoothing the loan book earnings, and then adding in the acquisition earnings going forward should see us keep growing our earnings and keep that momentum up.
Another question here on funding options you're looking at for the acquiring stores. I know you kind of mentioned, you've got that 20 mil every year to, dividends and acquisitions, but, would you consider debt funding, or do you think debt funding would need to come into the mix, if you're going to buy like another, if there's a group in the UK that has like 60 stores or whatever, or do you think, that 20 million is going to be sufficient for kind of any the groups or the strategy now, does they ever kind of really enter the mix when you're so kind of cash flow generative on a kind of 12-month basis?
Yeah, I guess back to the conversation around dividend, I get asked, would you consider a special? And have you got a lot of cash? I kind of feel like if we, that the network opportunity to buy the stores in both Oz and UK combined could be something like 80 to $100 million. So, there's obviously the operational integration pacing, but
Yeah.
if we have a big chunk of capital, we could go after it. The UK business, we deliberately carved out of the security charge with our securitization lender to make that business available to consider debt options, because the UK high street banks are funding this sector. There's two bigger listed peers that we've got. They're announcing quite frequently. It's a Lloyds, it's a Barclays, it's a NatWest type bank funding their business. So we've got some good conversations underway off the back of that. That support's been in place for years, actually. So I think carving that business out, growing that business earnings profile means we can now have those conversations in the UK. And we might look at a small amount of debt. We'd never overgear the business, but that could help us. In Australia, we're still a way behind that. Now, the big four banks are back to, talking that they want to grow and they're interested in funding the sector. It's really interesting how this has sort of done a bit of a 180 as they're coming to us
Mm.
now asking if they can get involved. Early days, let's see. I don't know. Yeah, we'll just see how those conversations go, but it's certainly positive, I think, in terms of some debt options we could consider.
And then I had one emailed in here, so I'm just looking at it on my phone. Oh, it's
Mm.
on rate cuts in the UK. So obviously we've had, three rate cuts there, down 75% of basis points. No move from the RBA yesterday. We've only 25 in Australia, but since the UK were out of the gate first, have you started to notice the impact of that coming through in terms of, loss rates, serviceability improvements? Is it feeding into what you're seeing in the UK, or is it still a bit too early to tell?
Yeah, the UK, it's interesting. The UK is a pawn and retail only business. We don't offer
Mm.
any unsecured lending products. So interest rate movements there, our customers are probably less sensitive obviously in terms of the loan books being secured over there. Um, Interest rate movements in Australia are something we do focus on, but employment rates in Australia are really key for driving our unsecured loan book performance in Oz. So employment's remained high in Australia. Unemployment rates are really low. We kind of model them, the unemployment rate increasing over time. I think it's kind of artificially low, but in the UK in particular, as the SIBOR or their LIBOR rates, their floating bank rates are coming down. The headline rates in the market that our peers are paying for debt funding are low. They start with a 7 maybe,
Mm.
which is something seen. So there's an opportunity there, I think, to get some pretty attractively priced debt if we went down that path. The performance of the customers, our business is fairly resilient. In tough times, we tend to do a bit better because people are looking for credit. But in the good times through COVID, we got a lot of quality inventory sold in off the back of that stimulus to our client base. They went out and bought stuff from JB Hi-Fi and
Mm.
Dixons in the UK, and that all that inventory came into the stores at the end of that period when they wanted to cash out. So we naturally run a pretty sort of like the business sort of stabilizes across the segment. So with the bigger part of the business being the unsecured personal loan business in Oz, though, we really watch that unemployment rate quite closely.
All right, Sam, we've nearly gone 10 minutes over time. I don't want to take up any more of your morning there in Perth. Thanks very much for joining us once again. And yeah, hopefully we'll have you back in later in the year, maybe when the full year result rolls around in August.
Definitely, yeah, good to see you, Mark. Thanks for having us.